Hello, our guest today is Peter Hewitt, manager of the CT Global Managed Portfolio Trust, which is an investment trust of investment trusts and comes in both income and growth versions. Peter, thank you very much for coming into our studio.
Yep.
We're heading into a new year. It's almost 2023. What are your investment tips, and are there any bargain trusts that you've got your eye on?
Well, Sam, often you can be a bit of a hostage to fortune with this, but I think that trusts invested in UK mid and small cap are quite well placed going forward. I mean, right now, they've not done that well this past year, and they are probably typically towards the wider end of their discounts. But my feeling is that once we kind of hit a peak in inflation, which probably isn't that far off actually, maybe in the first or second quarter of next year, and also interest rates kind of reach the level, whatever that may be, at that time we are actually probably going to be in a recession, or the recession is beginning to deepen a bit. But the stock market kind of looks 12 months ahead, and the 12 months ahead it will judge that inflation is coming down a bit. I'm not saying it's going to come back to 2%, but it will be declining. And so will interest rates. Now, both of those are good for the market. And I think for mid and small cap investment companies, probably quite a number of their holdings might be having profit warnings or missing their earnings, profits and earnings estimates. But actually, that's when you should be considering them. And I think, firstly, trusts exposed to the FT250 mid-cap index, that's where a lot of the genuine growth companies in the UK are resident. So I would say trusts like, say, Mercantile, Henderson Smaller Companies, they're both quite big, they're both liquid, they're both at discounts. Mercantile's got a bit of a yield as well. They could actually move quite strongly. And then also, you know, the small cap sector could also join in, perhaps later in the year. And I'm struck by, I had a meeting with Neil Herman, who runs Henderson Smaller Companies, has done for 20 years. He's got a great record. Like Mercantile, the shares are off about 40% this year, so they've been horrible. And he said to me, because I asked him, he said at the beginning of this year, the PE of his portfolio was about 18 times. Now, you'd expect it to be at a premium to the index, but that is quite punchy. When I met him last month, that PE was 11. That's a big de-rating. So that's some really quite good companies now relatively inexpensively valued. Now, who's to say the 11 doesn't go to 10 or 9? It could do, but it gives you an idea that probably quite a lot of the de-rating has happened. And I might be completely wrong on the macro outlook, but if you we do get to a stage where the worst has peaked, that's actually all it needs for the market, for the 250 index, the small cap index, to start performing. And these trusts at wider discounts could give you some interesting returns. So that's an area I'm certainly looking at for next year.
What are your favourite ways of generating income in your income portfolio? Do you look at stocks, alternatives, or perhaps even bonds?
Well, yes, predominantly equities, but I do have some alternatives. I've got I think 3 renewables trusts. I've got Hypnosis, the royalty income fund, which has not performed well, although the dividend's been fine. And I've got certain kind of specialist property trusts in healthcare. I'm thinking of Assura Impact Healthcare, which is owning care homes. I mean, they're not the most exciting, but they do generate quite a steady dividend, which grows. I think that's quite important. You don't want a fixed dividend at the moment. And that helps bolster the revenue account. But the most of the income comes from equity income trusts and And they are actually growing quite decently at the moment.
And what about capital appreciation in your growth trusts? What are your favourite growth investments?
I've been adding to UK trusts this past year, and I've been doing that, and I hopefully that will come through with some strong performance over the next year or so. But I've also got the sort of what I call long-term winners, the structural growth trusts that are exposed to areas of the economy, technology, healthcare, biotechnology, and some of the higher growth names. And that's been out of fashion of late. I've not come out of these completely. They are smaller positions in the portfolio, but it's important, I think, to keep them because they will start performing again. And I think it's from these type of trusts that you often make many times your original investment. So that's kind of the way I'm looking at the portfolio just now.
Private equity is one of those areas that you like, and HgCapital is one of your top positions. So why do you like the sector and that investment trust?
I think it's probably the best private equity trust. It focuses all its holdings on sort of software companies in Europe that are business critical, so not really consumer software, and they've got a fantastic growth record, some of them quite sizable. I think HgCapital, if its underlying companies were all taken together, is the second biggest software company in Europe. So it gives you an idea where it's invested. So the NAV, the net asset values, perform very strongly, and it's one I want to own long term. I like private equity trusts. They are selling at really quite wide discounts just now, and I think you should probably expect the net asset value will come back over the next 6 or 12 months. But how much will it come? I mean, are they going to fall 40% or maybe 5 or 10%? And if it's the latter, then a 40% discount is quite an opportunity. A reasonably well-run private equity trust almost always beats the all-share index over the long run. It's worthwhile remembering that. It's a great area to invest.
And why do you think the net asset value of these private equity trusts hasn't fallen yet? We're still getting, reports from the companies about the value of the companies they own, but they haven't fallen in the same way that public markets have.
How the private companies are valued is important. There is an element of comparison to listed alternatives, and that will have come back a bit. Quite a lot of merger, acquisition, takeover activity, often at premium. And if some of these businesses are growing quite fast, and in the case of HG, something like I think 25% a year is what their EBITDA, their operating profit growth, which is pretty strong. I mean, you're not going to get down rating those types of businesses, and sometimes they have an additional funding round where new investors are brought in, and that's often at a higher level. So we've not really seen much in the way of a downgrade of the asset value, but I do think it is likely you will see some reductions in the next kind of 6-12 months.
Another trust you own in the growth bucket is Scottish Mortgage. It's a favourite among our customers, but shares have had a really tough year. So why are you still holding on, and what could be the catalyst for a turnaround in performance?
Well, Scottish Mortgage has been a fantastic winner over the long term, and the shares got to about £15 a year ago, and then within 6 months they were £7, and I still held them. I halved my holding at about £13 in January, and I mean, it was a difficult decision, that. But now you could rightly say, why didn't you sell the entire holding? And I think the answer to that is that they have got great prospects longer term. Some of the investments they've made, they've got quite a lot of private companies and some of the technology and healthcare names in that portfolio, Illumina, Moderna, with the vaccine company, have got great upside. I think you'll not see that starting to perform until we see interest rates beginning to come down. And that may not be till later next year. So, I mean, do I think Scottish Mortgage is going to perform the next week, month, quarter? Probably not. But if you didn't own it, it wouldn't be a bad time to start building a position, because genuinely it's one you should be holding on a kind of 5 to 10 year view.
They lost their lead manager, James Anderson, quite recently. What is your reading of that? Do you think with the two managers in charge at the moment, which is Lawrence Burns and Tom Slater, do you trust them to deliver what James did under his tenure?
Well, the answer is yeah. I mean, Tom Slater was working with James for a long time. I'm going to say a decade. I'm not sure of the exact, but many years. And so he is now the lead manager. And it's not just Lawrence, they've got quite a big team with them as well. And Baillie Gifford, that's what they do, is kind of find some of these high growth opportunities in new areas, and they kind of take investments in them. Some can fail, but when they get a winner, I'm going to say they made something like 160 times their money in Tesla and Amazon, which are two of their better known ones. Now, they're not going to do that again because they're already humongous companies, but there could be ones coming behind which will give you some interesting returns. So I'm still relatively confident about that. That doesn't upset me too much that James is no longer there.
When investors buy shares in your trusts, they pay a fee to Columbia Threadneedle, but also they're paying the fee of the underlying investment trusts. So why should investors pay up? Why should they pay these double fees?
Well, yes, that's a good question, Sam. Our management fee is 0.65%. And what I would say firstly, on fees on our trust, and actually fees in certain areas like, say, private equity, where there's quite high fees, is, of course, we want lower fees. In case of private equity trusts, I do often ask them about that. But it's about not kind of losing the wood from the trees, because a lot of these trusts, despite the supposedly higher fees, still outperform the all-share index quite significantly. In the case of our trust, the growth portfolio had 9 consecutive years of beating the all-share. It didn't in the last year, it performed poorly. But, you know, so yes, it was fees, but actually, hopefully a professional manager who's, you know, will help to get some outperformance. The other thing about owning our trust is it has a unique feature, and I think it's unique anywhere in the London market, and it's this. The two portfolios have really nothing to do with each other except in terms of income and capital transfer. So let me explain very briefly. The income portfolio from the day we launched to today has an underlying yield of somewhere about 4.5. And the growth portfolio, and remember it's capital only, but some of the holdings do actually pay some dividends. Its yield is often 1%, give or take. So what we do is when a dividend goes into the growth portfolio, say Scottish Mortgage, very small dividend, it gets transferred across to the income portfolio. And at the same time, the same amount gets transferred back to the growth portfolio in the form of capital. So the growth portfolio gets a bit of an uplift, about 1% a year to its NAV. The income portfolio, and remember I said it yields about 5.5? Well, it gets about 1% extra dividend yield. Its NAV is about 1% lower, but remember it is partly an income trust, so it's total return. And that income transfer, I'm not sure if anybody else does it. What I can tell you, it's been massively beneficial, particularly to the income portfolio. I've never had to take big risks with high-yielding trusts that might cut their dividend. And it helps the growth portfolio a bit in terms of its capital performance too.
Finally, the question we ask all of our guests, do you personally invest in your portfolios?
I do. In fact, I only have 2 shares that I own, which is the growth and the income shares of the Managed Portfolio Trust. It's the same for the whole of the Hewitt family. So, yep. I mean, I'm signed on. If we have a horrible year, it affects me too.
Peter, thank you very much for coming in.
Thank you.
And that's all we have time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.